Infosys performance, and the numbers are now trickling in. The dollar revenue that stands at $3,782 million. The large deal momentum has been strong at 2.6 billion dollars, that is, on TCV. The revenue guidance for FY22 has been revised to 14 to 16%. Margin guidance has been retained at 22 to 24%. And I think this is the key number that the market is going to be absorbing. I just want to quickly tell you what is it that we were anticipating in terms of the FY22 revenue guidance, because the street was working with a range of about 13 to 15 odd percent. So the revenue guidance, which has been now revised been set at 14 to 16%, is definitely higher than what the street was anticipating. And I guess that also is part of the reason why you had Infosys go strong into its numbers. Remember, the stock held out by a solid 2.25% and closed today. Much of the excitement was also because of Mindtree's numbers, and that sort of rubbed off on the rest of the IT majors. Margin guidance, that's been retained at 22 to 24%. So just going by the guidance pictures, it looks like a strong set. Some of the other operational numbers coming in, 4.8% on a sequential basis. That's the constant currency revenue growth. The revenue stands in rupees terms at 27,896 crores. PAT has come in at 5,195 crore rupees. The operating margins of 23.7%. Revenue growth of 4.8% on a sequential basis in constant currency terms, and 16.9% on a year-on-year basis in constant currency terms. The digital revenues, they are at 53.9% of the total revenues. Just the first take, the numbers look a little ahead of what the street was penciling in. But let me take it across to my colleague Poonam Sani. She's been tracking the numbers far closely. Poonam, what is the scorecard looking like for Infi?
There's certainly a beat on the revenue front, Aisha. You're seeing a quarter-on-quarter revenue growth in constant currency terms at 4.8% on a sequential basis, and 16.9% YOY is definitely ahead of what we were working with. Do recall, Aisha, we were working with a number of 3.9% quarter-on-quarter, and this is a fairly strong growth. Of course, on the EBIT margin front, it's below our estimates. We were expecting a EBIT margin of 24.4%, and margins have come in at 23.7% during the quarter. Also, large deal signings are seen close to around $2.6 billion, which is fairly good enough. And even if I'm looking at across the verticals, vertical growth across the board has been fairly strong. For instance, financial services, retail, both these segments have grown at the rate of 22% YOY in constant currency terms. We are seeing a strong growth in the energy vertical, in manufacturing vertical, which has grown at 18.5% YOY in constant currency. Life sciences growing at 21% in constant currency. High tech growing at 15% in constant currency. So it's definitely a broad-based growth across the verticals. It's only the communication segment which has grown in low single digits of 4.6%. Even in terms of the geographies, very strong growth coming in from North America at 21%. Europe has grown strongly at 12% during the quarter. And also we're seeing India growth coming fairly strong at 20.7%. I guess the margin guidance has been retained at 22 to 24% for Infosys. But otherwise, it's a fairly strong number, and some of the commentary also is coming fairly strong, which is Mr. Salil Parekh stating that we grew at the fastest pace in Q1 in a decade, and which is a fairly strong commentary. Besides that, to recall, quite a lot of the analysts were expecting in revenue guidance to be upped, and some of the analysts were expecting the guidance to be up to 13 to 15%, but the guidance has been up to 14 to 16%. So this is a fairly strong guidance upgrade coming in from Infosys. So I would say a fairly strong quarter this time coming in from Infosys. Broad-based growth, FY22 revenue guidance upgraded, and yes, attrition has picked up to 13.9% across the industry. We're seeing attrition picking up. So we will have to watch out for what is the margin commentary, because the margins have dipped substantially
Right, Poonam.
than what we were
Poonam, just
expecting.
stay with us. I'm going to come to you in a second from now. We've got our experts as well joining in, so let's quickly take it across to them. We've also got the management commentary and quotations too coming in. But before anything else, Omkar, Sudheer, Sandeep, all of you, thanks for taking the time out and joining in. Omkar, if I could begin the discussion with you. The guidance definitely is a little higher than what the market was anticipating. Good numbers, you would say, a thumbs up from your end?
Yes, definitely we can say a beat in terms of revenue, but there is a decline marginally in terms of operating margin. But in revenue terms, definitely we were expecting around 4.4% of the revenue growth, which came at 4.8% on quarter-on-quarter basis, which was a major surprise. Even deal wins came decently at 2.6 billion. And the most exciting thing was they have revised its guidance upwards to 14 to 16%, which is again a big positive news from the Infy side. So which gives them visibility going ahead. So it's definitely a positive sign as companies or this results perspective.
Sure. Before I take it across to Sudheer as well as Sandeep, I'm going to quickly read out what the commentary from the management is like, because that has also got a very bullish undertone. Employee well-being is of paramount importance to us, and we have had multiple interventions in this regard, including facilitated vaccinations for them and their dependents. We rolled out several intense employee engagement initiatives, including career acceleration opportunities, compensation reviews, and learning and redevelopment interventions. Our clients continue to be supportive of the multiple initiatives that we have undertaken. They value the delivery commitments we have met during these extraordinary times. That's the word coming in from Praveen Rao, the COO at Infosys. Also, he says that as the demand for digital talent explodes, rising attrition in the industry poses a near-term challenge. He says we plan to meet this demand by expanding our hiring program of college graduates for FY22 to 35,000 roughly globally. That's the addition coming in from him. Another word coming in from Salil Parekh, the CEO and MD, saying driven by the dedication of our employees and the trust of our clients, we grew at the fastest pace in first quarter in a decade at 16.9% on a year-on-year basis and 4.8% on a sequential basis in constant currency. I am proud of our employees, Salil Parekh goes on to say, who as one Infosys demonstrate resilience and commitment in delivering for our clients. He says this gives us confidence to increase our revenue growth guidance to 14 to 16%. That's the word coming in. He also says as Infosys completes 40 remarkable years, its continuing success and global impact are a testament of the vision of the founders and all the leaders who have shaped the company. So bullish management coming in, saying that it's been a record fastest pace of growth that they have incurred in the first quarter, and the visibility going forward as well remains strong. It's only the CEO Praveen Rao indicating that attrition may actually pose a challenge considering its digital talent that they are focused on towards right now. But Sudheer, what are you making of the numbers right now? What's the first take?
Definitely, revenue is slightly ahead of our expectations at 4.8% constant currency growth in sequential terms. This is almost 40-50 basis points ahead of our expectations. Margins were tad lower, roughly around 90-100 basis points lower than our expectations. And in terms of guidance increase, we were expecting a more gradual revision to guidance. Probably from 12 to 14% earlier, we were expecting that to come to at least 13 to 15% sort of a number. But there was a pleasant surprise, as in there are a couple of percentage points of a step up in terms of revenue growth guidance. Margin guidance, we were anyways not expecting the company to step up the margin guidance, so it's kind of in line with the expectations. And in terms of the large deal momentum, I think $2.5 billion, more or less in line with the company's trends over the previous several quarters. If you look at average trends for the previous several quarters, of course, we'll have to listen from the management as to how the split of renewals and new in this $2.6 billion will stack up. So overall, I would say this is a good result, despite some sort of a miss on the margin front.
Okay, meantime, Praveen, pardon me, Omkar, let's get in a view as to how you're looking at the overall operating margin guidance as well. That's been retained at 22 to 24%. And how are you reading into the large deal momentum, $2.6 billion in TCV?
The large deal swings that came are much in line with our expectations. I mean, they are fairly decent. They have won the previous large deal swing in previous quarter exactly at the same rate. So it is fairly going enough. And on the margin front, the wage has impacted the overall margin performance in overall all the sectors. I mean, all the companies, those are in IT. So apart from that, there is a transition cost that is involved, so that have also impacted the margin a bit. So and we see, I mean, the rising cost may impact of going ahead because they have retained the guidance for 22 to 24% going ahead. So we can say, and there might be some impact in terms of margin going ahead, but I believe the higher volume growth may offset some of the operating expenses by 22.
Does the guidance, the revenue growth guidance being revised to 14 to 16% in cross-currency terms versus the 12 to 14% earlier give some amount of added confidence? Sandeep, that question was for you. Okay, we seem to have disconnected that line, but Omkar, let me get in your view as to how you're looking at the overall guidance instilling confidence, the fact that it's been raised.
Yes, it's definitely giving an higher visibility in terms of revenue growth and the growth that they are going to achieve, and the ramping up the deals that they have won in the previous quarters. It's definitely building up help in building a confidence in terms of overall scenario.
Nilanjan Roy, the Chief Financial Officer, as well, saying that they remain confident of delivering margin guidance, cost optimization program to negate increasing cost headwinds, which are arising from the compensation review, talent acquisition and retention. So that is the company talking about how they're confident about retaining their overall margin guidance. Reconnected then with Sandeep Agarwal. Sandeep, I was asking about the kind of confidence that it instills, the fact that the company has retained the FY22 operating margin guidance at 22 to 24% and the revenue guidance being revised higher to 14 to 16% versus 12 to 14% in cross-currency terms. I think he's not really connected with us still. Sudheer, let's get in your take as to how you're looking at these two parameters.
Yeah, so in terms of the margin guidance, as I highlighted earlier, neither ourselves nor I believe the consensus is actually expecting a step up in terms of the margin guidance. So that retention of 22 to 24% guidance, I would say, is the kind of base case expectation for the street any which ways. So there is not much of a surprise or disappointment factor over there. Now coming to the revenue growth guidance, while the management has guided for 12 to 14% sort of constant currency growth in the previous quarter, while they have guided for this sort of a growth for the full year, Street is still building in 16-17% sort of a growth. So kind of consensus is ahead of the guidance in terms of building revenue expectations for FY22. So from that standpoint, I would say not upgrading the guidance would have been a negative rather than reading, the upgrade as positive. Having said that, we were expecting a more gradual step up in the revenue growth guidance. Probably we were expecting a 1 percentage point step up in the revenue growth guidance in this quarter, followed by another 1 percentage point sort of a step up in the guidance in the subsequent quarter. So what surprised us is the 2 percentage point step up in the guidance rather than 1 percentage point step up in the guidance.
The only correlation that I can draw with Infi as well as TCS is that their employee cost has been rising and attrition continues to be a concern. If I can just read out the comment coming in from Praveen Rao, the Chief Operating Officer, once again, he says, as the demand for digital talent explodes, rising attrition in the industry does pose a near-term challenge. He says, we plan to meet this demand by expanding our hiring program of college graduates for FY22 to around 35,000 globally as a headcount, he adds. So they just wanted your sense on, what is it that you're making of the salary costs and whether that's a looming threat for most large cap IT players, as was the case with TCS, seems to be the same problem with Infi as well.
I would read this more of as a transient problem because what one should note is the fact that fresher hiring or campus hiring used to be a significant part of the overall hiring needs of these companies. Right, but last year and this year, the possibility of going for a fresher hiring and then training them physically in a location, that prospect of that was dented because of the lockdown situation we are in. So the fresher hiring / campus hiring program has kind of taken a pause, or it was not to the extent that it used to be in a typical year earlier. Because of this, what's happening is most of the companies are kind of scouting for talent, which is in the lateral end. Most of the companies are kind of scouting for lateral talent, which is why there is a near-term impact in terms of the availability of the lateral talent. But I would read this as a short-term or a transient phenomena. I would not read too much into it. I would say, large companies like TCS and Infosys, which have very strong human resources supply chains, which have built very strong human resources supply chains over a period of time, should not find it very difficult to source talent going ahead. I would read it more as a transient, let's say 2 to 3 quarters sort of a supply side issue or supply side bottleneck rather than a long-term structural problem here.
I think we have Sandeep back on the phone line with us. Sandeep, it's a given that Infi has done what TCS couldn't as compared to a muted quarter from TCS. It's been a beat in terms of revenue and the guidance as well. Trajectory has been moved upwards. That said, in terms of the valuation metrics, TCS is expensive both on an FY22 and FY23 estimated basis. But Infi on a 1 month basis has already moved up roughly about 6.5%, and year to date it's up 22.5%. Add to that the cheer on the stock today as well. Part of it, I guess, was also to do with Mindtree's numbers rubbing off on the rest of the IT pack. But do you believe that these numbers for the previous quarter merit any sort of change in your price targets or recommendations on Infi?
So, my price target is 2200 for a long time. So, I don't know whether
management.
And vaccination protocols followed. All our participants have been fully vaccinated, and we are coming to you live